The coupon code for the Alpha Report, Schumer Siesta, ends tonight at meetkevin.com. Jeffrey Gunlock, legendary bond investor, has some real warnings for the market, especially private credit, and tells us to keep some money in cash.
But we like that, and then I would have about 15% in cash right now, because I really think things are at a very aggressive level, not just gold, but which is certainly was at 4,400. But I certainly think that a stock market which is very narrow in breadth. I know it's better than it was before, but when I started following the stock market, it was in the early 70s. I was 12 years old, but they called it the Nifty 50, and that preceded a pretty big correction down, a pretty big drop in 1974. But now we have the Nifty 7. I know it's a little bit broader than that now, but there's a huge difference.
It doesn't feel it sometimes.
Part of that is probably because of the concern about cockroaches. Let's listen to Jeffrey's take on the cockroaches.
You've had some of the issues around subprime auto, obviously, that we've all been focused on, wondering because of what Jamie Dimon said, there's never just one cockroach. You told me like 13 months ago that you were concerned, and this was out at Future Proof out in Huntington Beach. If you recall the conversation we had then, where I asked you, as everybody was talking about the prospects of a private credit bubble, you said you saw one. I'm wondering whether you now see the first cracks in it.
Well, there sometimes is one cockroach. I mean, that Silicon Valley Bank, that was sort of a one cockroach situation. A lot of people thought that was the beginning of something.
I mean, First Republic went down too.
I thought it might be contained, and it turned out that was the case. But
yeah, because the Fed bailed everything out.
Weaker activity in parts of the lower tiers of the credit market, and there's been more than one sort of write-down or default scenario that's already occurring, and they seem to be occurring kind of in a cluster. It's not like there's one and then 6 months goes by and then you get another write-down somewhere. They seem to be happening in a cluster, kind of like the layoffs are starting to happen in a cluster. So I think that private markets broadly have stopped outperforming public markets. That's certainly been the case in recent times with the public markets doing so well. I just think that there's going to be a liquidation that will occur in the next significant economic weakness period that is going to be surprising to people how much selling and unwinding there's going to be of what I think is an overinvestment in these private markets, both private equity and private credit.
That doesn't sound very bullish, that there'll be a liquidation in private markets because of an overinvestment into some of these private leveraged deals. What he's referencing is a lot of these are highly leveraged private credit funds in arcane financial instruments where people don't even know anymore what they're investing in. They're just investing in some kind of random product because it's like, oh yeah, some banker told us we were going to get some, really good return on our money. Sometimes I feel like people don't even know that their money is in these products. It's kind of scary. And so this is where Jeffrey's like, hey, if you're in some of these arcane assets, maybe it's time to diversify out. That's personally what, I look at this, I mean, he's kind of right. Equity valuations, asset valuations everywhere are kind of high. It's one of the reasons I love so much what we're doing with House Hack and Reinvest, because our valuation is based on August 2024 as just a real estate company. And now here we are coming out with an AI product, in the next few weeks. That's not in our valuation at all. So we think we're a real estate-backed AI opportunity that's trading at old valuations, whereas everything else is mega high. And here's Jeffrey going, get out of private credit, these private debt, opportunities. And the bankers are pitching. We saw what happened with Tricolor. Let's see exactly what he says. So I think he's got some interesting insight. I think he suggests there could be a rush for the exits here.
Major asset pools that have got themselves into illiquid positioning because of significant investment in private markets, and they don't have any money. That was famously Harvard University back when they were getting, their donors were pulling back because it was going on campus. I think Yale's been talking about liquidating some of their private equity interests and the like. And that's usually the sign of overinvestment, and the liquidity will dry up and it will turn into sort of a liquidation cycle. That's my map. I don't think it has to happen this week,
Right.
but it's been a process that's been developing over the course of this year. But I think that's going to be at the foundations of the next kind of financial problem that we
Crisis
have in the United States, and perhaps beyond the United States borders, but certainly
it'll
there's a lot
ripple
of
everywhere
investment in that category. So I caution investors. I think if you have liquidity options, some funds, they allow a liquidity option. They'll give you a mark periodically on their private credit book, and if they allow a partial redemption and you don't see any degradation in the marks on the private pools, I would take advantage of that liquidity function, because I think you're
basically
going to be
get out.
getting out at a better level than you'll be able to get out at in future quarters. So I'm very focused on private credit being an issue.
Okay.
Wow.
We'll follow that. There's certainly a lot of focus on it. You've given our viewers a lot to think about today and plenty of actionable ideas.
Yeah, and the fact of the matter is, with these private credit profiles, these are often funds that you can get into, and what they do is they allow a certain amount of liquidity per quarter when you're investing in a fund as opposed to like a company, right? So you invest in a public stock, you just swipe up or whatever to buy or sell a stock. You invest in a private company, you might be buying shares or like convertible bonds in a private company. But you're choosing that company, so you know the assets that company has, the balance sheets that company has, whatever. Like, Househack, for example, we don't have any bank debt. You can see our public balance sheet, whatever. You go to reinvest.co, you read the offering circular, househack.com, whatever. It's the same company. But these private credit funds, what happens with them is usually you'll have windows where you can exit a private opportunity. But they'll only allow a certain amount of liquidation per quarter. So we saw this, or we regularly see this anytime there's a crisis, where you'll say BlackRock or Blackstone or whatever, they'll say, oh, okay, we're at max redemptions for the quarter. So if you're trying to get out, you're gonna have to wait for the next quarter, and you have to wait for the next quarter. And they do that to butter out redemptions. But it has some serious potential risk factors, because what happens if you then get stuck holding the bag? And as Jeffrey Gondlach says, what happens when people see or start getting more nervous about other cockroaches, then liquidity dries up. Remember, you can't sell if there's no buyer. That's why sometimes order books can get destroyed so quickly. People think that these stock prices or crypto prices are stable. They're not. They're entirely based on somebody else being willing to buy. Why does Fiserv go down 44%? Because a lot of people got spooked and there just weren't buyers lined up. So what happens? The order book gets chewed through. It's the same reason why when things start going down, alts like altcoins, certain cryptocurrencies or tokens plummet, because there just aren't that many buyers in a crisis who are going to go buy Fartcoin or whatever it is. So the smaller or more arcane the product is, the more rapid the unwinding. Like, who wakes up in the morning and goes, yeah, I'm going to go invest in Fiserv? Sure, they might be a big core financial plumbing, participant, but that doesn't mean there's such a big participant in the economy that people wake up and go, I want to buy the dip on that stock. Almost any other stock that we have up on screen, whether it's favorite of ours like Axon, or whether, somebody wants to go buy the dip on the Qs, or Meta, or Microsoft, or Google. Google's actually up 5%, or whatever. They're joining the FOMO in on Google, whatever it is. You have buyers ready to buy because these are such household names. When there are no buyers and people are wanting to sell, the valuations collapse really, really rapidly. And I think that's why we look at that IMF report, and I certainly scratch my head at that IMF report, because the IMF report tells us, the whole foundation of this report is the Global Financial Stability Report, and they talk about the shifting ground beneath the calm. And they take a lot of time to discuss the problem with private credit markets and how much money has now been exposed to private credit. But not only that, they also talk about the market basically ignoring the potential effects of tariffs on inflation and growth. Well, I suppose it could also be an either or. And that sort of ignoring is a potential red flag. Not only that, but then you've got fiscal deficits at governments, which is another crucial sign. There are three things: are tariffs, fiscal deficits, and then private credit. Private credit, by the way, this non-financial intermediaries, NBFIs, that being the particularly scary one, where they say 90% of the lending to these non-financial intermediaries is from big banks. But big banks are globally and systemically important. You know, we call them the G-SIBs, which if they are the ones that are throwing money, let's say, at these non-bank financial intermediaries, and, you know, we now have high allocations to assets that might have really bad collateral support. So in other words, the underlying value of the bonds or debts go to poop. Then you could have quote unquote severe dislocations. And maybe the reason we haven't seen that, you know, during liberation was because it was such a short period of time that we got liberated compared to, let's say, March of 2020, where we had many more weeks of pain. But non-financial or non-bank financial intermediaries could amplify market stress from the side of leveraged funds that so far was limited in April of 2025, but basically could become an issue again over time, especially when we look at banks and we see, wow, you know, banks are increasingly lending to private credit funds because these loans offer higher returns on equity than traditional commercial and industrial lending. 5 large fund managers account for 1/3 of aggregate loan commitments. Banks lend to a variety of these, and bank exposure is pretty large at 9% of bank portfolios, totaling $4.5 trillion. So what happens when that $4.5 trillion, people to go look at the underlying assets and they're like, oh wow, it's just, you know, a First Brands, like the underlying collateral is absolute trash. Well, you know, then you have big poopsie doopsies. So while large banks serve as primary lenders to non-bank financial intermediaries, accounting for 90% of all lending to these, exposure concentration is more large among large, or is more severe amongst large regional banks and those with assets under 100 bill. And they go as far as suggesting that some of these companies might not be able to actually fund the amount of withdrawals that could come to these banks. That as many as 4% of US banks might not have enough liquid assets to actually pay people's outflows. So you could end up having Silicon Valley style stresses hit again, and stress tests aren't actually monitoring these correctly because, first of all, the IMF isn't even going to consider what happens if banks potentially go bankrupt. They literally say we don't even consider the solvency of these banks. But a lot of banks do not have the reserve ratios in the event we end up going into some kind of liquidity crisis because of this private credit cockroach situation. So people think the banking system is sound and resilient because that's what, you know, Jerome Powell always tells us. And, you know, that might be wrong. So kind of a crazy environment we're in. And so I think Jeffrey's kind of right to think about, you know, check where your money is. If your money's sitting with some bankers and you don't really know what's backing up your assets, maybe it's time to diversify a little bit into at least where you know or sort of trust the underlying assets.
Why not advertise these things that you told us here? I feel like nobody else knows about this.
We'll try a little advertising and see how it goes.
Congratulations, man. You have done so much. People love you. People look up to you.
Kevin Paffrath there, financial analyst and YouTuber. Meet Kevin. Always great to get your take.